This video on market efficiency discusses information asymmetry, which exists when one party in a transaction has better information than the other party in that transaction. And so the consequence is that the party with the superior information has the unfair opportunity to earn excess profits at the expense of those who are not quite so privileged. And some of the features of information asymmetry, which by the way you can also refer to it as informational asymmetry or asymmetric information, include the concept of lemons and plums, adverse selection, and moral hazard. These are summarized right here. So lemons and plums exist when the buyer and seller have different sets of information in a transaction, and so we have informational asymmetry. So the consequence of that is that the buyer is now unable to distinguish between what's good and what's not good. You know, lemons are tart and sour, and plums are sweet and juicy. So when one party is eclipsed to some degree, then you're going to have this situation where you're unable to distinguish between the two. The other is adverse selection, which is a feature of informational asymmetry occurring prior to the transaction and exists when buyer has information of which the seller is unaware, at the outset, right before the transaction takes place. So here I give a couple of examples, one of which is that individuals in dangerous jobs or high risk of loss are quick to want to buy insurance, so they know that there's a high probability of loss, and so they go ahead and buy insurance already. Providing false information on a loan application with the intention of using the funds to go ahead and gamble. So you already knew your intention ahead of going ahead and applying for that loan. So you misrepresented your intentions, and as a result, what you are getting ready to do after the fact would adversely impact the well-being of the lending institution, so to speak. And the third here, moral hazard, is a feature occurring after the transaction, which is a situation in which one party takes unusual and costly risks, knowing that any financial losses would be borne by the other party. So a couple of examples here. Look over here. Say a property owner buys insurance on the property, and as a result is less inclined to take care of that property. You could take out a car insurance, and then knowing that your car has full coverage, you don't really care too much about where you park it, because if it gets stolen or damaged, the insurance company will step in and take care of the loss. Something that probably would not have occurred if you didn't have insurance. And so that's, now you understand why it is that insurance companies include features such as deductibles and co-insurance. All of these are supposed to fight against these types of moral hazard. And so on, here's a feature of how that arose quite a bunch in the period leading up to the 2008 global financial crisis. So you can pause this video and read up my summary on this and a couple of studies dealing with this issue. So some of the consequences of information asymmetry include insider information, agency problem, and conflict of interest. These are summarized in turns. So the first, insider trading, which I guess everybody understands what that really means, is actually the buying or selling of an asset by individuals in possession of two important attributes: material and non-public information about that asset. So if you possess material information but which is made public already, then you're not going to be accused of insider trading. Likewise, if you possess a non-public information, say some internal release of information by a firm, but that information is irrelevant in the pricing of the underlying security, no one is going to accuse you of illegal insider trading, which, by the way, it's important to understand that not all insider trading is illegal. All right, so insider trading can be both legal or illegal. It is legal when trading takes place by corporate insiders, and such trades are sanctioned by regulatory authorities, as I note here. However, it would be illegal if you have not been so authorized. There are things that are in hiding, and then you took advantage of that privilege to go ahead and make a killing. And by the way, it's not just corporate insiders, as I note here. Any individuals who, such as stockbrokers and family members who have connections with those corporate insiders and who use those privileged bits of information to help others trade would also be charged of of violations of insider trading. Agency problem is an interesting one because it emanates from the concept of agency theory, which is a study of how the problem of asymmetric information affects the behavior of the agent. In the case of a corporation, it's going to be the manager in the performance of his or her fiduciary duties on behalf of the principal, who in this case is going to be the stockholder or the business owner. And so the question is, does the agent have the best interests of the principal at heart? Because if that's the case, then the agent is performing his fiduciary functions, in the absence of which there has been a violation of that agency relationship, which involves that fiduciary responsibility. And so that then leads to agency problem, which would exist when the principal is unable to fully observe or control the agent's actions, when that agent is misappropriating funds and conducting business in ways that do not attend to the best interests of the stockholder, of the owner of the business. The third, conflict of interest, occurs when an individual or firm has competing interests, and where serving one interest could involve working against the other. And so right down here, I know that in financial services, conflict of interest can result in moral hazard, as we've explained, especially where the fiduciary role of the financial intermediary has been compromised. And I show some examples where that conflict of interest can exist in financial services, such as in the case of underwriting and research, and credit assessment and consulting, and auditing and consulting as well. So I summarize these in the next set of slides. In the case of the first, underwriting and research, would be where, for example, investment banks conduct research for firms. This is a paid service that they may provide firms with, as well as doing their traditional job of underwriting securities for those firms, basically selling those securities to the public. And so as you can see here, the potential for conflict of interest exists because the investment bank conducting paid research for the firm, might want to talk up the firm's performance, even when that may not necessarily be true, because it's going to cause many people to be interested in buying the firm's securities. And so they're going to talk it up, and then people are going to pay a premium to buy those securities, when in fact those securities would not be selling as much if in fact they were hip to the real true story about the company. The second one here is credit assessment and consultant by rating agencies. These rating agencies, these are credit rating agencies. They assign a credit rating to a security issued by a company. And the credit rating, as you know, would help investors to determine the credit worthiness of that security, which is the likelihood of default. But as you can see, if the rating agency also serves as a consultant to the firm, for which it's going to receive a fee, then what could wind up happening is that the rating agency might assign false credit rating to the firm securities, giving the firm securities, say, AAA, when in fact it should be BBB. And then, on the other hand, investors relying on that credit rating, not knowing that the credit rating agency also is in the big pockets of the firm, will go ahead and do business with that company, thinking that the security issued by that firm is indeed AAA, when in fact it's trending toward a default risk status. And so that's a huge problem that occurred around the 2008 financial crisis again, because you might have read how Moody's and Standard & Poor's assigned AAA ratings to toxic collateralized debt obligations issued by their client firms. These CDOs were complex derivatives, and many investors put millions of dollars into these CDOs, which eventually, as the story went, um, down the tubes. And then thirdly and finally is auditing and consultant by accounting firms. Now, auditors, of course, their main job is to review the financial records of firms for accuracy of information. The goal of which is to provide an unbiased opinion of the firm's financial health. Now, though, but the same auditing firm could also be a consultant of the firm, and therein lies the conflict of interest. And a wonderful case that many have referred to for years after it occurred in 2002 is the case of Enron and Arthur Andersen. So Enron was the big utility firm headquartered in Houston, Texas, and Arthur Andersen was one of the big five accounting firms that provided false reports about Enron, and no one knew that Arthur Andersen at the same time was hand in glove with Enron. In any event, long story short, Arthur Andersen, the accounting firm, was forced to shut down its accounting practice in the United States, and found guilty of falsifying its audit report of Enron. And by the way, Enron is no longer in play today, because it was all a shady deal. So these are a couple of recent legislations in the United States that attempt to that are designed to reduce moral hazard in the financial services industry. And that's a wrap.